Thanks for tuning into this quarterly market update. I want to take a few minutes and just review with you some things that are happening in the markets and what the themes have been so far this year. Basically, there have been four themes that we see that have been really ongoing since January 1st. One is the market volatility. There's been a lot of market volatility this year in both directions, and in the end, to date, the market's up about 1%. So I think that if we can withstand the volatility and look at the bigger picture, everything should be okay in the end. The second theme this year is interest rates. We continue to hear about not so much if the Federal Reserve will be raising rates, but now it's more like when they will be raising rates. I think the summer is out. We could be looking at as early as September, and if not September, perhaps by the end of the year. So we'll be hearing more about this as time moves on, but it is adding some volatility into the marketplace, and I think that eventually when rates do start to increase, the market will probably work its way through it. The third theme that's been prevalent this year is the price of oil and gas. We started off the year with a pretty significant drop in energy prices, which has been very good for consumers, both for transportation and home heating. We did start to see an increase just recently, and now we're back on the decrease. But that's adding to the whole volatility of commodity prices, and we don't see that really ending for the rest of this year. And the fourth theme is Greece and China. Greece has been in the headlines every day. It seems like they've been in, for the last few years. This is the third go-around now with the bailout. But with the Greece effect and the European Union, and then with the Chinese stock market having lost so much of its value in the last few weeks due to it increasing so rapidly, that has sent volatility shockwaves through our market. So I want to just take a couple minutes, highlight each one, and let's put it all into perspective. As far as the market volatility, I think the best way to sum it up is, as I said, the markets are up about 1%. But if you just look at last week alone, you know that from Monday through Friday, the net result of the Dow Jones average was positive 29 points. But when you looked at it day by day, we've had extremes. We were up 211 on Friday. We were down 261 early in the week, and we've had a lot of give and take. But in the end, the market was slightly positive. So this is the way the markets react to news. I don't think it'll stop. There'll be more world events, and sometimes these events come back and affect our markets, although it's not an indicator of what our economy is doing. We just have to get through the volatility. We said at the beginning of this year we expected a lot of volatility, and we don't see it going away. So we're trying to control the risk in our portfolios. We think we have a good allocation and good investments, but you can't really escape the volatility. Interest rates. Every time the Federal Reserve meets or one of its governors gives their own opinion in a way that the market doesn't like, the market responds. But in the end, what we see is if interest rates are going up, that must mean that the economy generally is doing well. The economy is it's slow and steady. It's not where the economists would like it, but if rates go up, it's usually an indicator that there is some stability and there is some strength in the economy. As I said just a couple minutes ago, let's see where the interest rates, or when the interest rates increase. We do expect it, if not in September, then perhaps before the end of the year. But history shows that when interest rates do increase, generally the returns for the market over the 6 months after the increase are relatively good. I wouldn't expect it really to be any different. The third theme, again, is oil. It was down, it was up, now it's going back down on the possibility of an Iran agreement being ratified. Oil is down today, it was down significantly. That's great for the consumer, and eventually it's great for the economy. It takes generally 4 to 6 months for the savings that's being felt by the decrease in energy prices to trickle back into the economy. We're not talking about big dollars, but in a total effect, it will have an impact. It takes about 4 to 6 months. Oil is back down. Will it stay down by the time we get into heating season in this part of the country? That remains to be seen. But it is a positive for the economy, and we would expect to see more of that commodity volatility throughout the year. If the Iran deal stays together, it'll put downward pressure again on these prices, and in the end it's good for the consumer. The last item was Greece and China. Greece, now this is the third go around with this bailout. It appears that they have an agreement. It's not one that they are really happy to have, but it is something that they needed. The effect on the U.S. if Greece defaults or goes bankrupt, it's not that the United States has a big financial interest in Greece. It's just that it could start the chain reaction from some of the other countries, Portugal and Spain, and there's issues with Puerto Rico's bonds and so forth. It could start a global trend of defaults. Greece is not leaving the European Union, which has created some stability. The markets like what's in this agreement, and it appears that in the end things will work out well for the world markets. Greece is in a tough spot. They need to raise taxes, they need to cut benefits, they need to really take a hardline stance on some things in their country so that they can pay their debt, pay their interest, and pay their pensions. So right now it looks like it's headed in the right direction. Our markets like it and they feel comfortable with it. China, we've been hearing a lot about their news as well at the same time as Greece. China's stock market basically has exploded. The investing public in China has taken an interest in the market. They've put a lot of money into the market, and as a result of that, they bid this market up very high very quickly. They've also implemented, they're using margin. They're buying on margin, which is not a new concept, but one that's new to China, where they're borrowing money to pay for stocks and buy their investments. And that works well in an increasing market. But when markets are going down, margin positions need to be closed and people have to sell out of their positions. So as a result of that, their market has come down significantly over the last month. Now, the U.S. always looks at the Chinese economy as they're a big producer of goods, and if their economy is slowing, it does have its effect on the world economy. But right now, their markets seem to be somewhat stable. The bleeding has stopped. They've actually had a couple of big updates last week. So right now, we think things are okay there. And as a result, it's come back home and it's helped stabilize these markets. So in the end, we'll make our quarterly adjustments as we normally do. We like the way we're positioned. We're being very careful with some fixed income in terms of bonds, as bonds react adversely to rising interest rates, so we'll be very careful with that. We'll make a couple of changes. We like the way we're positioned. We're controlling risk and maintaining a diversified portfolio. As always, if you have any questions, please call me. We'd love for you to come and see us, or email me, and we can go over things in more detail. We appreciate you tuning in, and if there's anything we can do to help you, just let us know. Thank you.